So for everyone who's out there wondering what the economy is going to look like, the Fed's cutting rates, global central banks around the world have been cutting rates, and the PMI hasn't started to rise yet. And I think a lot of that had to do with the fears over China and the fears over the whole tariff situation.
The other thing is the ongoing refinancing of the debt means the ongoing liquidity. We're seeing China printing money. You know, all of that whole game, the everything code game, is still at play. One of the things that's happening right now is the government shutdown, which means that the Treasury can't spend the Treasury General Account, which is actually the only straightforward liquidity mechanism they've got, because they aren't using the balance sheet and the reverse repos drain. So the moment the government shutdown opens up, then liquidity starts pouring in.
The global economy is entering one of the most misunderstood phases of the cycle. Central banks are cutting rates, liquidity is quietly returning, and yet the world still expects pain instead of growth. But what if this time the script has flipped? What if we're heading into one of those rare macro windows where falling rates and accelerating growth collide, creating a perfect setup for risk assets across the board? That's the central theme driving a recent Real Vision discussion between Raoul and Jordi Visser, the founder and chief strategist at Visser Labs, two of the sharpest minds tracking global liquidity and exponential innovation. Visser argues that while markets have been obsessed with fears of China, tariffs, and stagnation, the next phase is already being written by AI-driven productivity, infrastructure spending, and a flood of new liquidity entering the system. The Fed's pivot is just the beginning. As rate cuts ripple through global markets, pent-up capital expenditure and debt refinancing will unleash fresh liquidity across the economy. And according to both Powell and Visser, investors aren't ready for what comes next, an environment where the economy accelerates even as rates continue to fall. That combination is rare, it's powerful, and it almost always sets the stage for a surge in asset prices. And yes, that includes Bitcoin and other crypto assets, because in a liquidity-driven world, the same forces that inflate equity and real estate valuations also power the next leg of the digital asset cycle. So in this video, we'll break down exactly what Raoul and Jordi Visser see coming, why they believe 2025 could mark the start of a massive new liquidity wave, and how this cycle might reshape markets in ways few are prepared for. Before we dive in, make sure to hit that like button, subscribe if you haven't already, and turn on notifications for more insightful analysis from some of the industry's brightest minds. Thanks, and enjoy the video.
I always love starting with the macro, because I think we're leaving a world, so let's get the stuff that's in the rearview mirror and let's get into the stuff that's happening now and the stuff of the future. Let's do it this way. I'll just give you kind of my my latest things that I'm writing about, which I think are the most important. So the Fed, let's say, pivots towards worrying about labor, and that happens in August at Jackson Hole. And you get all the cries from people that are worried about inflation, and the cries from people that believe the Fed is making a policy mistake. And I think you and I are both, in this point of that eventually labor is going to be disrupted by exponential innovation. And I've written two pieces this week specifically on the fact that it's here, it's now, and as we leave 2025, the number one most important thing for people is this year was a transition year where inference started to accelerate in terms of token usage, which leads us into the next stage of artificial intelligence, which I've called stage 2, where stage 1 was where these machines and these bots went through undergrad and they've graduated. They have 160 IQ now, and that number is only going to continue to compound every month and as every release comes out. But that just means we're closer and closer to knowledge workers being disrupted, and knowledge workers make up a huge percentage of obviously the United States labor, and that's going to start in much bigger fold this year. And the problem is you've already seen Walmart. Now you've seen Amazon make the headlines. You've seen Accenture, 3 of the 4 biggest private employers in the country, have all said, we're not going to be hiring. We'll hire eventually, but they've openly said that they're not hiring. And I'll just bring this up because I highlighted this chart last week, which is if you have a long-term chart of earnings per share and you overlay it with two separate labor indicators, one just temp employees hired, temps have been going down consistently now, really since 2022. Exactly right around the point that ChatGPT got launched. And then secondly is just the JOLTS number, which obviously went up dramatically during COVID, but has come back down. But those two things were very, very much correlated almost exactly to earnings per share in the S&P. So we've entered that very dangerous point where, especially from the big companies like Amazon who are spending lots of money, they need to be reducing employees to stay competitive. And I think one of the mistakes people have made is that they actually believe, number one, AI is not going to do that. That's a mistake. Well, you and I both know that. Number two, they kind of view it as, well, the companies are not going to fire the people. And the reality is, in a capitalist world where your shareholders determine and your board determines what you're doing, you are absolutely going to see profit margins be the way that people are going to focus on. And I think we're at that inflection point right now where this labor situation, which has reached levels unprecedented, where you could have nominal GDP growing at 5% and no creation of jobs outside of healthcare, we're already seeing it. And I just don't think enough people that I'm speaking with recognize how quickly this has come on and how we're at the very beginning stages of something that goes exponential in terms of the labor side. And how do you catch up to exponential? So this is never going to get better on the labor side. It's only going to either stay the same or worsen. And I think that has huge implications. And that's what I've been writing about lately.
So does that mean that unemployment rises or we just stop employing people as GDP grows?
Well, see, this is an interesting question. This is the way I've been framing it for people lately, because you and I both know that, I mean, one of the charts that you highlight a lot is the labor force participation rate. Okay, well, the labor force participation rate I've redefined as the rate of people who need to work. Because you end up in a situation where there's two things that can make people not need to work. One is they're fully on transfer payments, which means they're getting money from the government. They're getting subsidies. They're getting the transfer payments, which have been built up in Social Security and everything else. Or they've made enough money because they've had enough money in stocks. But either way, it's a need to work thing. So you've had a lot of people leave the labor force. And I think the labor...
Or it's an age thing, right? If you're in your 80s, you're unemployable.
Yes. And I think to a degree, I'm including a lot of the older people in the side of receiving pensions or receiving something like that. But you're right. There's an inability to be in which the demographics keep worsening. And I know you guys highlight the demographic side. For me, the reason this is important is because even just since May, the labor participation rate, I think, is down 0.5. We'd be at a point where the unemployment rate would be closer to 5 right now if the labor force hadn't shrunk. And so the problem is, as the labor force participation rate goes down, we'd be closer to 8% unemployment if we didn't have it fall so much since the great financial crisis. And I think that's
also to do with immigration as well.
Well, immigration theoretically should be reducing the supply of labor. And this is kind of my big issue, is when people talk about the fact that immigration is becoming an issue for the hiring numbers, that's all well and good, but then why would the Conference Board differential be worsening so much, saying that the anxiety for workers is that they won't be able to get a job? So that doesn't match up with the surveys, and then people can say, well, that's Trump related, that's whatever. The reality is, it's the hiring market has absolutely worsened. And that's why I bring up Accenture, I bring up Walmart, I bring up Amazon, because Amazon has the same amount of employees as it did in 2022. So they're about to reduce again. The issue is, if you look back at their employees and the growth they had from 2007 up until now, it was a linear line. I mean, it was literally like it just went up by nominal GDP every year, and now it's not growing anymore. So we've broken the connection where as GDP goes up, we don't need to hire any people. And you and I have talked about this before, but I think one of the big macro mistakes that's happened that has led to people not understanding why we don't have recessions anymore. Yes, the Fed has these liquidity facilities, but the other thing is we just saw 7 companies go from $1.5 trillion to 15 trillion, 16 trillion, 17 trillion, 18 trillion in market cap. And they took no debt to do that. That has never happened before in the history of mankind with capitalism. So you had a breakdown in those relationships of nominal GDP versus debt. Well, now you're having a breakdown in nominal GDP versus people. They both have to do with software, and they both have to do. Software was already doing this, Raoul, is really my point. We just didn't call it the same thing as what's happening with AI, because AI is more dangerous now.
Visser begins with the labor market, what he calls the silent disruption. He explains that the exponential rise in AI and automation is already reshaping the workforce, starting with knowledge-based jobs. Major employers like Walmart, Amazon, and Accenture have all paused hiring, signaling the early stages of what Visser describes as the decoupling of growth and employment. In other words, GDP can keep rising even if job creation stalls. Raoul agrees, pointing out that this shift marks a fundamental change in how the economy operates. Corporate profits can expand without additional labor, driving higher margins and potentially higher equity valuations. But that also means inequality will widen, and with it, the pressure on policymakers to respond with both fiscal and monetary tools. This is where the macro meets the markets. Fewer workers, stronger profits, and an economy increasingly supported by liquidity and innovation rather than sheer labor expansion. Which brings us to the next big question. If growth remains resilient while inflation fades, how will the Fed and other central banks react?
So what does that mean? Before we dig in more into the AI side, what does it mean for the economy? It puts the Fed reaction function towards cutting more? Or do they realize what the problem is? And it's like, well, this is not a stimulus-based thing. Is it a fiscal thing that ends up happening? What is the outcome of this? Because growth is not going to slow.
So unfortunately, if you go back to let's use the K-shaped economy, we know the bottom end of the K is very dependent on interest rates by definition. So whether it's commercial real estate, whether it's real estate itself, whether it's auto sales, or whether it's individuals, they depend on the fiat system, which is credit based. They need to borrow money to go through this, where the things on the top end, wealthy people, the Mag 7, they don't care about interest rates. In fact, the higher interest rates go, the more they benefit from it. So I think what it's done, and I think what has happened is this still becomes a relationship between the dual mandate. And the reason that I think it makes sense for the Fed to be cutting is that everyone's fears about inflation were wrong. And there's just no other way to say it. I mean, the tariff numbers are as high as what people were worried about back in April, and yet we're not getting the inflation that everyone thought feeding through. And that's because, as you and I both know, I mean, AI is an incredibly deflationary force.
The most deflationary thing that could ever exist.
Yeah. So again, if you're going to hit labor, and wages on every metric have gone lower since the peak in 2021, 2022. I just don't see how they're going to be able to do anything other than cut rates. Now, the administration, and this is something that I don't hear people talk enough about, this White House is filled with AI people in it all the time. And you don't have to believe in everything about AI, meaning I'm not an AGI person, meaning I don't believe in the concept that there's this magical thing that just kicks in and there's one winner and everybody loses. I do believe in artificial and general intelligence. I do believe in it being deflationary, but they've put the boogeyman in both the White House. China is worried about it because from a military perspective, but honestly, Demis Hassabis does not want to rule the world. I mean, he seems like a really nice guy who just won the Nobel Prize. And when he talks about things, he talks about people living forever and him being able to be a part of that. I think Elon Musk cares about putting people on Mars. I don't think he's into making more trillions of dollars. They're not driven by this thing. I mean, they're gamers. They're nerds. They're people that are trying to do stuff. So I think when in the context of the way Wall Street looks at this stuff, they're still focused on the monetary policy side, where I think monetary and fiscal are going to be aligned, which is we have an inequality situation, which is only going to worsen. And the more deflationary it is, the worse the situation gets. And so I think their job is going to be to help people, especially when we go into a midterms. The one big beautiful bill was structured in a way that the ramp up of everything is going to happen as we get into the first half of next year, leading into that. So for everyone who's out there wondering what the economy is going to look like, the Fed's cutting rates, global central banks around the world have been cutting rates, and the PMI hasn't started to rise yet. And I think a lot of that had to do with the fears over China and the fears over the whole tariff situation. I think everything is going to go higher because of all the spending in CapEx, all the pent up stuff from the one big beautiful bill, and all the rate cuts, which we know is a leading indicator for all of the things that'll go higher. And so I don't think people are ready for a situation where the economy is going to be growing at the same time that rates are coming down.
Yeah, I get the same read of this. And the other thing is the ongoing refinancing of the debt means the ongoing liquidity. We're seeing China printing money. All of that whole game, the everything code game, is still at play. One of the things that's happening right now is the government shutdown, which means that the Treasury can't spend the Treasury general account, which is actually the only straightforward liquidity mechanism they've got, because they aren't using the balance sheet and the reverse repos drain. So the moment the government shutdown opens up, then liquidity starts pouring in. And then we've got the change to the SLR coming, and then the reserve requirements to banks next year. I mean, there's a shit ton of this stuff that's kind of orchestrated to allow liquidity to flow.
Yeah, and even though it won't be QE, the reality is QT is ending. The Fed's balance sheet is going to minimum stay the same, but you're going to have less of the duration selling, more of the money in the front end. And again, I think it's more liquidity. You don't have to call it QE, but it's like, okay, that money's going to get levered up. I mean, it's a fractional reserve banking system. It's going to get levered up. So,
and what impact, I'm trying to think this thing through, impact the government shutdown has. My guess is they won't re-employ all of the people that are furloughed. Yeah, that is potentially a shock. And I think Scott Bessent certainly would like that, because it forces the Fed to cut faster, which he needs because of the K-shaped economy.
Yeah, and I think that's where they're going to try to err on the side of the government employees, which, again, if people don't realize, I mean, you're talking about one of the largest employers in the country.
That was the growth in the jobs numbers.
Absolutely. And I mean, if people don't know it, I mean, you're talking as much as Amazon holds, the government has 20 times the size of Amazon. So it's like when you go through the numbers, guys, I mean, and that doesn't include the contractors and the people that are associated. That's just the pure government employees. So I think we all realize that there needs to be a lot of innovation in there. And I think the job situation, they're going to force it out of the public sector and into the private sector. And that's not a good game for job creation to be doing that and moving through it. And so again, I agree with you. I just don't think this is going to be an environment where job creation is going to happen. And without job creation, it's very difficult for me to get to the point that inflation is going to happen, and very difficult when the inequality is there, because at the end of the day, inflation has a component which is driven by the median voter and the median person in the economy. And that's when you get into this. The wealthy people don't spend more money because stocks are going up, or they don't go to the supermarket and buy more of goods. It's still a volume game. And if the average person can't afford their groceries the same way, it actually has a negative or deflationary, it offsets the thing. So the inequality to me, is a very deflationary thing as well. And so I think it reinforces.
That puts 2026 as a very strong year potentially for asset prices and economies, right? Because we've got kind of everything swimming in the same direction.
Yeah, I think the part that's been left out this year will participate next year.
As the conversation unfolds, both Raoul Pal and Jordi Visser reach the same conclusion. The coming policy response is not about fighting inflation anymore. It's about managing liquidity. Visser believes the Fed will keep cutting rates, global central banks will follow, and new spending programs will push liquidity even further into the system. Raoul adds that even without formal quantitative easing, the combination of Treasury spending, reduced quantitative tightening, and upcoming regulatory changes will create the same outcome: more money sloshing through financial markets. And that's where the story turns incredibly bullish for investors. Because when liquidity expands while growth remains stable, it acts like rocket fuel for risk assets, especially those driven by narrative and network effects. Bitcoin, Ethereum, and other crypto assets thrive in precisely these conditions: falling real yields, rising liquidity, and growing institutional confidence. We've already seen early signs of this shift. The government shutdown temporarily froze Treasury spending, but once it reopens, liquidity injections will resume. China is printing again. Global liquidity indicators are ticking higher. And if you look back through history, every major surge in crypto valuations began at moments exactly like this, when policymakers flooded the system with cash to keep growth alive. So whether you're tracking equities, gold, or crypto, the message from Pal and Visser is clear: liquidity drives everything. And if they're right, the next few months could mark the beginning of a powerful, synchronized uptrend across global assets, one where Bitcoin once again becomes the leading signal of future capital flows. Do you believe the next big move for crypto has already begun? If you found this breakdown helpful, please like the video, subscribe to the channel, and let us know in the comments what you think about Raoul and Jordi's take on liquidity and growth. Thanks for watching, and we'll see you in the next one.